Welcome to DealHub. In this video, we'll take a quick look at what is revenue and its core concepts in the world of business. What is revenue? In simple words, revenue is the total amount of money a business generates through its core operations, like selling products or providing services, before any expenses are deducted. Revenue isn't just one size fits all. It is classified into different types depending on the nature of transaction. Operating revenue. This is the money your business makes from its day-to-day products and services. Non-operating revenue. It's the income from peripheral sources like investment interest or legal settlements. Accrued revenue. This is the revenue recognized on the books for work completed, even if the payment is still pending. Unearned revenue. These are prepayments from customers that are recorded as a liability until the service is actually fulfilled. To better understand where your money is coming from, let's look at the primary sources of revenue for modern businesses. Sales revenue. This is the total proceeds from selling your inventory or manufactured goods. Service revenue. This is the revenue recognized when a specific service or project is completed for a client. Subscription revenue. This is the stable, predictable income from long-term contracts or monthly memberships. Advertising revenue. This is the revenue earned by displaying ads on your website, app, or physical media, and other marketing efforts. Licensing and royalties. These are payments made to your business for the right to use your trademarked or copyrighted material. Interest and dividends. This is the earnings generated from the business's financial assets rather than its core products. Let's understand the difference between revenue and income. Revenue represents the gross amount of money generated from business activities before any costs are taken out. In contrast, income is the actual net earnings, showing exactly how much money is left for the company to keep after every expense is accounted for. To track performance and forecast growth, businesses rely on several key revenue metrics. Let's take a look at them one by one. Total revenue, the complete sum of all money generated from all business activities during a specific period. Net revenue, the amount remaining after subtracting returns, allowances, and discounts from your gross sales. Gross revenue, the total value of all sales transactions before any deductions are made. Average revenue per user, ARPU, a measure of how much revenue the average customer generates over a specific time frame. Monthly recurring revenue, MRR, the predictable total revenue a business expects to receive every month, common in subscription models. Annual recurring revenue, ARR, the value of the recurring revenue components of your term subscriptions normalized to a single year. Customer lifetime value, CLV or LTV, the total amount of money a customer is expected to spend with your business during their entire relationship. Churn rate, the percentage of customers who stop using your product or service during a certain period. Customer retention rate, the percentage of existing customers who remain loyal to your business over time. Conversion rate, the percentage of potential leads or visitors who take a desired action, such as making a purchase. Sales growth, a metric that measures the ability of your sales team to increase revenue over a fixed period. Profit margins, the percentage of revenue that remains as profit after all costs and expenses are paid. Let's take a look at how to calculate the net revenue of a business. You can calculate net revenue by taking your total gross sales and subtracting any customer refunds or promotional price reductions. In terms of formula, net revenue is equal to the total gross sales minus the sum total of customer refunds and promotional price reductions. The revenue cycle is the continuous process of generating income, beginning the moment a lead is captured and continuing through sales and fulfillment. It concludes only when the final payment is collected and recorded, ensuring the entire transaction is successfully converted into cash. It is important to know the term revenue recognition while learning the core concepts of revenue. So what is revenue recognition? It is the process of deciding exactly when a sale counts as earned in your financial records. Instead of tracking when you get paid, it focuses on when you have fulfilled your obligation to the customer. Calculating revenue isn't always straightforward, as several complex factors can impact the accuracy of your financial reporting. Let's take a look at some of the major challenges faced while calculating the revenue. Revenue recognition's timing. It's a challenge of determining exactly when a sale is officially earned, especially when services are delivered over long periods. Variable pricing models. It's the difficulty in tracking revenue when prices fluctuate based on usage, volume discounts, or performance-based milestones. Customer refunds. It could be quite challenging to accurately reconcile and subtract returned payments from gross totals to avoid overstating earnings. Accounting for discounts and allowances. It is a challenge of managing the gap between the sticker price and the actual cash collected after promotional or volume-based price reductions. From initial sales to final recognition, a clear view of your revenue is the foundation of every successful business decision. Thanks for watching. To learn more, check out the guide on revenue at DealHub.io.